Okay, so thank you, everybody. Thank you for tuning in. Thank you for sparing your Saturday morning with us. So today's topic is GTA real estate market turning point. So we'll see if we feel it's turning now. So that's the goal. Let's see. Today's, as usual, I'll do my PowerPoint presentation followed by expert panel. So we have Kishore, Bhavin, Prerna, Amit, and Rajat as mortgage brokers. We have Sandeep Chopra, Jaya Singha, and Amit as lawyers. Pani would be insurance broker. Prasoon and Mohit are the financial advisors. Deepak and Mustafa are accountants on our team. So, a quick disclaimer, we do our best to bring all the information from the reliable sources, but again, we cannot guarantee its accuracy. So, we advise everybody take proper action before they take or proper due diligence before they take any action. Thank you. Now, agenda for the day. So today we would first discuss April 2026 market report, followed by our topic for the day if the Toronto market has hit its bottom, right? It's not that I am saying that or I want to say that. It's the CBC News which had this news. So we just want to analyze that. Should you buy now or wait? Because if the market is coming down, is it going to come down more or should we take action right now? So that's a big question. A lot of people want to understand. And then there is a big news right now happening in the market. There are a couple of big companies who are right now buying condos in bulk. So we'll discuss that, followed by interest rates, whether you should go fixed or variable is always a hot topic. And we do have our expert panel helping us with that. So we would talk to them about this topic as well. And then we'll have our Q&A session as usual. So let's discuss our April 2026 market report. So now this is the number of sales. In the month of April, we sold about 6,000 homes. It's exactly 5,946 homes we sold in April, which is about 7% more than same time last year. So it's not a huge jump, but there is a gradual increase in number of sales as compared to last year, right? So, which is a leading indicator. We always say volume is a leading indicator. First, the number of sales has to go up, and then slowly the prices will creep up. So, if we look into this graph, this is showing we were looking at sitting at the bottom. If at the bottom, if you see this, so this line right at the bottom was where we started. So, in January, we had the lowest month of January on record for the last more than 10 years. So, we sold only about 3,000 homes in January. Then we went up and we are now close to about 6,000 homes. So we are getting better day by day in number of sales, right? And then if we look into the months of supply, which is another good indicator that the market is going into a better direction. Now, months of supply, as you all know, is means that if there's no new homes listed in the market, how many months will it take to sell all the homes available in the market? So usually, if it's less than 3 months, it's pure seller's market. Between 3 to 6 months, we call it balanced market. More than 6 months is called the buyer's market. But for GTA, for Toronto, I would say specifically, we have not seen 6 months plus inventory. We only saw it for a very brief period. But we feel if it's more than 5 months, it purely goes to the seller's market. That's how the sentiments are here. So we were closer to 4.8 months of inventory last year. Now we are down to 4.2 months of inventory, which means we are going much better into the balanced territory at this moment. It's not buyers or sellers market, it's balanced. Now, if we look into the number of sales available, so we are now, if you see near the top, we are second lowest or second highest number of homes for April. Last year, we had much more homes. We had closer to 28,000 homes around this time. We are now closer to 25,000 homes. So number of homes available to sell are coming down, right? So which means more homes are getting absorbed. So we are selling a little bit more number of homes and we are having lesser number of homes to sell. So both are uh, going towards a tight market again, right? So we had at one point of time 30,000 plus homes last year during the month of June, July, May, June, July. We'll see whether we will be there this year or not. Normally, we always have more uptick in number of homes to sell during the months spring and summer, right? Then it goes down slowly. This is again, you can see all the graphs from every year. So we would be seeing more homes for sure, but it will be interesting to see if we go closer to 30,000 or not. We doubt it. It will cross 30,000 again. I think it will remain closer to 27, 28,000 at the peak, which will be still less than last year. Now, the average sale price, as I mentioned, the average sale price is the lagging indicator. First, number of sales has to go up, then the prices will start coming back. Right now, prices are still dropping as compared to last year. So last year, April price was 1.1 million approximately. Now we are closer to 1,050,000. So we are about 5% below last year price. But keep in mind, we are going higher as compared to month over month. In March, we were about 1,017,000. Now we are 1,052,000. So prices are going up slowly month over month, which is again seasonal. We'll discuss that a little bit in detail. So the next slide actually shows, if you see here, this is again second from the bottom is this year. So our average sale price is better than 2019. This is last blue line at the bottom is 2019. Now, the reason I have put, or we have put 2019 here, because a lot of people are saying our prices are actually below 2018, 2019. No, we are much better than 2019 pricing, but we are still almost closer to the bottom in the pricing for the last 5 years since COVID, right? So this is the average sale price right now in the market. So now let's discuss this topic if Toronto market has hit its bottom. So this, as I said, was a CBC News article where CBC has come up with this article saying that, or they were asking this question, if the Toronto condo market has hit its bottom. Specifically, they wanted to talk about the condo market because condo market is the main leading market, which is bringing the whole market down, right? Condo, as we know, were in a bad spot for the last few years. But as per CBC, this is closer to the bottom. And the reasoning they're giving is now the first thing is they are quoting a TREB, Toronto Real Estate Board, which is suggesting now that we are now selling more number of homes or condos as compared to last year, right? So the number of sales are going up. Prices are still dropping. So prices for condos came down 6.4% for the same period. So the prices are coming down, whereas number of sales are going up. As we discussed, prices will come back always later, right? So also, this is a graph showing how the prices have changed over year for condos. In 2022, when the peak was there, average condo price was around 800 and closer to 50,000. So 850,000 average sale price. And from there, we are down to 665,000. So we are down almost like 30% or more than 30% in some areas. So if we look into this, every year we have a peak in spring, then the prices always come down later in the year, right? And winter is the lowest. Again, it starts going up year over year, if you see, then comes down later in the year. So the same trend has started this year. We were at the bottom in January. We have started going up. So right now, we are going again towards the new peak, which will be definitely lower than last peak. But it will be interesting to see if we again start dropping much longer or much higher as we have done in the last couple of years. So that will be interesting to see. And only then we can say whether this January pricing was bottom or not, right? So we are right now actually going up in pricing as normal, which is seasonal, right? Now, if we look into So that's why I'm saying this is a cautious optimism. So there is optimism. Now we can say the prices are going up. Number of sales are going up. Prices are slowly going up only for the last few months. I'm not saying prices are going up as compared to last year, but prices are going up month over month. So probably it will, if it sustains, even if it stops dropping, that will be a win. Because before a bottom happens, or when a bottom happens, first there's always a plateau, meaning the prices stop dropping more and then it starts rising. So we have to find that plateau. We are not sure we already hit it or not, but we'll find out soon. Right. Now, the another big reason why the prices were going down so much and why we had such a bad condo market, especially for the last 3, 4 years, it was all because of pre-construction. So pre-construction condo buyers were facing the most important challenge in real estate industry. We haven't seen that type of challenge in the last many, many years. People are losing almost all the equity they put it in the pre-construction market. Not only that, they're losing even more than that, right? So that's the reason now there's no new construction anymore. So in fact, there were 9 projects that were canceled last year. So there are no new projects being launched anymore because there's no demand and there's no hunger from the market. So if it remains the same, then probably we would not have much supply coming down the line. As you all know, it takes probably average 4 years for a condo building to complete, right? Meaning from the time they start selling to the time the units are completed and you get possession, it takes about 4 years as an average. So now, from the last 2, 3, 4 years, we are not selling new buildings anymore, which means come 28, 29, there's no new supply. And if there's no new supply, only the condos which are available now would be sold in resale. And that probably will be the turning point for the condos, right? Now, let's look into this number of sales for our GTA market. This is again not for condos. This is overall average all homes types. So all home types, if we look into, this is a graph I have created for our audience here. So we can see here that our number of sales are going up and up month over month. From January, we only had about 3,053 homes. And now we are closer to 6,000 homes. So this is a good, I can say good uptick in number of sales. Usually this is seasonal. I have to say that it's not that this is unusual. Every year we see the same trend. Every year that number of sales goes up in January to February, February to March, March to April. But interesting to know that last year from 3,800, we went in April to 5,500. So it was a gradual increase. But this year, from 3,000, we went to almost 6,000. So this is a much more steeper increase in number of sales. So meaning our market or number of sales activity is getting much better now as compared to last year, right? Again, it's a very small sample. We'll have to see a few more months to see if this trend continues. And then we can definitely tell you, yes, we have hit the bottom. But at this moment, it's going in the right direction. And if you look into the price, same thing, the price is going up since January. We came down to 970,000. So this is the lowest sale price in last 5 years, average sale price, right? And now we are back to 1,050,000. Again, this is seasonal. Prices always go up from January to February, February to March, March to April, and then they start dropping later in the year. We'll have to see if that trend, how it changes, right? But it's going in a better direction, and this increases again a little bit more sharper than last year's. No. So now, should you wait or should you buy now? Right? This is $1 million question. Everybody wants to have an answer that if I have to buy, should I buy now or should I wait? Right? So Everybody's situation is different. You have a different need. So one size does not fit all. So I would not make a general comment that everybody should jump in now and start buying. Everybody depends where you want to buy, what you want to buy, and that can change the situation completely. So I would say if you have that specific question in your mind, talk to a team. We can look into your situation and we can advise you whether you're better buying now or better waiting. But I would definitely say this is the time to start looking into it, right? To start talking about it. No, let's look into why we are saying whether you should buy now or you should wait. Since February, March 2022, since 2022 peak, the average sale price overall has dropped almost 25% in GTA. Condos have dropped much more, between 30 to 35%, whereas freehold homes has gone down between 15 to 22%, depending on location. Depends heavily on location. And I want to stress that factor. We always call in real estate, there are three important factors in real estate. And you know what those are? Location, location, location. Meaning location is the most important factor in real estate. But this factor was completely out of picture during post-pandemic. Most people bought homes far away from the city. People went as far as up to, say, Barrie or, say, Oshawa, Bowmanville in the east, or they went towards, say, Hamilton, Niagara Falls, or in Kitchener, Waterloo, London. Like people were going all away from the city during COVID times, feeling, hey, we may not have to come back to the city. And all those areas which were far away places from main Toronto actually gained the most appreciation, right? Those areas gained the value and they appreciated the most. Now, those are the regions which are now experiencing the most uh, decline, right? Reason being, because now people know, hey, we have to come back to Toronto. Work is coming back. Everything is again happening in the main areas, right? Or closer to GTA areas. So location is again becoming a very important factor. Now, and for that reason, if you see, the Hamilton and Oshawa are the hardest hit markets right now. They are down anywhere between 35 to 40%. And these are houses, not condos, right? 35 to 40% drop in the value of homes, like freehold homes, like detached homes, or semi-detached or townhouses in these areas. Brampton is another example where people, actually, there's many other reasons, but Brampton is next. It's around 30 to 35% drop in value. Downtown, mainly in Toronto, condos are suffering more. So they have softened a lot. And the main reason for Toronto condos to come down was not location, it was because of oversupply and weaker rent market. And also investors fatigue, which means investors were out or they were forced out of the market, right? So these were the reason Toronto condos came down, whereas other areas were because of location, right? Now, what is expected? So this market is very confusing. Prices are still softening as we have looked into it. We are down almost 5% from April last year, although we are now starting to creep up. Inventory is tightening. So that's the important thing we need to keep in mind. What you're buying, you have to see what is inventory of that type of property. If that is also tightening, you need to pay attention to that, right? And then also we have to see what is happening with the condos are now showing signs in life. So condo, which were in Toronto, the main reason the market was coming down and the average price was coming down was condos. Freehold homes in GTA or in Toronto itself did not go down much. Actually, if you go into the main Toronto core, like you go towards, say, Lansdowne, you go towards, say, High Park, you go towards any main Toronto areas, you would see the prices, even in beaches, they are actually going up. And there are already multiple offers happening in those areas, right? So, but the condos are now also showing the sign of life, which were actually going down. So at least they have started selling only good condos. So still there are some good condos and some bad condos, and we can discuss that later on. So some good properties or good condos have already started moving. Builder inventory is moving fast. And the reasons are HST rebate. HST rebate is the game changer. The government has introduced this new legislation. It has not been passed yet. I just want to say that. It will pass very soon. We are waiting for the royal consent, but government, both federal and the provincial government, has already announced that they are giving this HST rebate for any new construction home or any new home sold directly by the builder from 1st April 2026 till 31st March 2027, only for this 1 year, right? So during this 1 year now, what it does is it has brought down the price of this new construction about 10%. The reason I'm not saying 13% because there was already a rebate of up to 24,000, which was in place, right? So now it's 13% minus 24,000, or depending on that rebate, which was already in place. So about 10% prices have come down already, which is a big drop. And that's the reason a lot of people are now picking up the inventory left out by the builder. Once this inventory is gone, what will happen? Not only that, once this rebate is gone, which will end in March 2027, the prices simply have to go back another 10% higher. This 10% drop in resale market, new construction market, was also putting a similar pressure on resale, because resale people have to understand, and they were accepting the fact now that, hey, because the new construction is down, we in resale have to adjust as well so as we can compete with that. So once this HST rebate thing is gone, probably the new construction prices will have to go up, and then automatically the resale will also go up. So keep that in mind, and that may be a reason why you should buy now or you should wait. Again, as I said, everybody's situation is different. We can discuss it in more details. Your particular situation, call us for more information. Now, also, keep in mind, location is again becoming the most important factor, right? So depends where you're buying and what you're buying. And again, as I said, Toronto freehold market was always tight, and it's actually becoming very tight, and multiple offers are back. Quality condo units are now moving again. In fact, we have sold 3 condos in the last 2 weeks in our team. So which means condo which were sitting for a long time are now getting back into action. First-time buyers are re-entering the market because they are feeling they were waiting for a long time. Now is their time, right? Affordability has improved. And most importantly, this bulk condo buys. They're putting a lot of pressure on inventory. So they are going to absorb the most of the unsold inventory in the unit, in the market. So let's now discuss this unsold inventory or bulk condo buys in GTA. Now, what is bulk buy? You know, we have always heard about bulk buying in different type of commodities, but we never heard bulk buys in properties, right? But what's happening is, so this is happening in Toronto. As per Urbanation report, there were about 10,000 unsold inventory in GTA, which means these are those condos which were sold at some point of time, but people did not close and builder have taken them back. So most inventory came from there. And a little bit of inventory was from unsold, which they never sold at the first place. So that is inventory where now those builders want to get rid of it. They're already giving out a very good price for those properties or those condos because they have already taken 20% deposit from those people who bought them in first place, and then they did not close. So they already have the 20% in their pocket. And they're ready to lose a little bit more from their side because they were making huge profits when they were selling these properties during the peak time. So they can cut down the price further down. So they are now ready to sell those properties at a price which is actually below, much below the replacement cost. And also, builder may be losing a little bit money. But as I said, they already have 20% in their pocket. So they are not the losers. So that inventory, because now that those prices are much below the original price, on top of that, HST became the game changer. Government said any inventory which builder is directly selling now will also be subject to this HST rebate. So those condos suddenly became 10% extra cheaper, 7, 8, 10%, depending on what price point they were at. So suddenly there's another 20, 30, 40, $50,000 drop in their pricing from the already reduced price by the builder. So they became very, very attractive. For that reason now, there are two corporations or two funds which have been created, and they are picking up these condos from the market. These are multi-million and multi-billion dollar programs, right? So the first of them is actually from High Art Capital. So this is a 1.3 billion fund which is partnered with Building Ontario Fund, which is a Ontario provincial agency. So they are partnering, they have partnered with this High Art Capital. They have gathered $1.3 billion and they are going to buy 2,200 units and they are going to rent them. They are saying they will rent about 25% of them at below market rent. That's why government is chipping in. But in any way, there'll be 2,200 homes or condos absorbed by them right away. And they're going to buy in bulk. They're not buying one each. They're going into a building saying, how many units are left? 10, 15, 20, 30. We're going to buy all of them together. Give us a break. And then they go to the next building. That's how it's happening. So this is the news. They started in March, on March 18th. That was the news when it came out, when they started this fund, right? And they are starting coming with $1.3 billion. And the next one is a private company from Montreal called Jastas Group. Jasta Group is a private owned company. It's not a government company. There's no government involvement. They also felt the GTA market right now, especially the condo market, is at a point where they can make money out of it. So they are buying condos worth $500 million. So they have already bought $30 million condos, yes, near TMU, Toronto Metro University. They already bought 30 million and they are going to buy another $470 million condos. So they are trying, and their aim is not to rent it cheaper than the market value. And their aim is not to bring the rental market down. Their aim is to make money. It's a complete private program, right? So they are saying that their main purpose is to buy them now and hold it and then sell it when the market comes back. And they have projected a timeline of 3 to 4 years. They're saying between 3 to 4 years, because there'll be no new construction, there won't be any new supply. Prices they're buying are already rock bottom. So they are hoping there will be enough gain for them that they will sell them and make money, right? So this is what they are doing. They're going to buy about 1,000 of these units. And this is a company who already deals with the luxury yachts and hotels and resorts, right? So this is not any average real estate company only. So they know what they are doing. They know because they are spending $500 million, right? So this is what's happening right now. So this is from their their director. So their managing director has said that we are not pretending to be affordability savior. They said we are here for a business, and we are not here to help the market. We are actually we think this is the right opportunity for us to make money. No. So if these two big companies can take action and they feel this is the right time to buy now these condos and then use them to make money down the line, probably it is the time for average consumer also to think of that and see if you can also take similar action, right? But again, it's a very different market. You have to have a lot of analysis done. So if you have any questions, please let us know. Again, biggest role, why they suddenly jumped into it right now is HST rebate. As I said, this rebate just started in March, from actually 1st April. It was announced in March. And as soon as it was announced, these funds were created to now pick up all these properties. And this is only for 1 year. After 1 year, this rebate will be gone, and the prices again has to go up automatically after a year. So that's the reason. Now, next topic, very interesting topic. I know a lot of people want to understand interest rates, where they are heading to, whether they are coming down or going up. So I don't want to make any prediction. It's not my expertise. It's not my forte. We do have our expert panel here who would be making their comments on this one. But what I would do is I would actually give a little bit of information, what controls interest rates and what are major banks saying, and then we'll ask our expert panel. So as you know, our interest rate right now is 2.25. That's Bank of Canada's target rate, right? And this is sitting at this point since October 2025. Since October, we have not touched interest rate. In fact, last year during October, November, we were talking whether they will drop further or not, right? And then we started asking whether they will go up or not. But again, we'll see what happens. So let's look into this. So this is one factor which plays a very important role in interest rates is unemployment rate. So the unemployment rate is right now 6.9%. It has started going up. It was sitting around 6.5% in January, then went up to 6.7% in February and March, and then went up to 6.9%. You don't have to be an economist to understand that if unemployment is increasing, probably our economy is getting weaker. And if the economy is getting weaker, I don't think interest rate can go up too much. Again, just my understanding, and we'll ask our expert panel on that one. Second factor, which also play most important role in our interest rates, is inflation. Inflation is actually probably the biggest reason why Bank of Canada increases interest rates, right? It's a common saying, we have used this line many times before, that Bank of Canada would prefer recession over inflation. They would rather choose recession rather other than or having inflation. So which meaning they don't want to see this inflation go up again. So we have started seeing inflation going up. Last year, our inflation was around 1.7, 1.9, under 2%. Our target, or Bank of Canada's target, is to keep it closer to 2%. So they were very much on target last year when they were dropping interest rates, right? And then it started going up. Again, closer to 2.2, 2.3, 2.4, where they were very happy till March. And suddenly interest rate or inflation rate has now gone up to 2.8%. Why it's going up, everybody knows. I don't think I have to tell oil what is the reason for the oil, why it's going up. Everybody is aware of Middle East and what's happening and why interest rates are, or oil rates are going up. And that is causing a huge instability in the market, right? And because of that, actually, Bank of Canada was expecting this inflation to be more than 3% this month. But surprisingly, it came down to 2.8%, which is better than what they expected. So they are happier, right? So, but let's look into this. It seems interest rates or inflation is very high, 2.8%, or is going higher. But don't forget, we have seen inflation as high as 8.5% or more than 8% in 2022. And that's the reason, and that was the time when actually they started increasing interest rates, and they increased interest rates drastically to bring down this inflation from 8.5% to under 2%. Now, inflation is again going up, but it's not going up at the same pace because there's no free money. This employment is also very poor, right? And also at that time during COVID time, employee had a lot of leverage on their employer. They were saying, increase my salary, otherwise I'm going to quit and join another company. Now, actually, jobs are also at risk. So don't think there is too much fear in the market about the inflation, or this inflation is going to go out of spiral like last time. But again, we'll ask our expert panel about that. Last thing, this is what Bank of Canada said. So probably Bank of Canada has some room now because of this inflation coming below 3% as per Desjardins. And now let's discuss what these five major banks are saying about interest rates. So TD is saying that interest rates will remain 2.25% throughout 2026, and they are not hoping any increase in a near future, even 2027. So TD is very optimistic. They're saying it doesn't matter what's happening, interest rates are not going to change. Same thing is BMO. So BMO is almost at par with TD, saying interest rates will remain similar and they will remain at same place, around 2.25%, right? Same, no, CIBC is a little bit of on a negative side. They are saying interest rate will remain at 2.25% for 2026, but they are predicting two hikes in 2027 of 25 basis points each, which means by end of 2027, they are saying there'll be two increases and interest rate can go up to 2.75%. Whereas National Bank is saying interest rate remain 2.25% for this year, again, in line with all other three banks above. And they're also saying that there'll be two increases of 25 points each, and the interest rate will be 2.75% by end of 2027. And lastly, Scotiabank is the most conservative in this thing. They are saying there would be actually increases, three increases of 25 points in this year, meaning the interest rate will go to 3% this year alone, but then they will hold it for the next year. And sorry, lastly is RBC, our sixth bank. They are saying interest rate will remain 2.25% for 2026, in line with other four banks, but they are expecting a full 1% increase in 2027. So that the interest rate will go to 3.25% in 2027. I know it's very confusing, even for me, and it will be confusing for everybody else sitting here. So we would actually ask to our expert panel here to chip in. So these are the next announcements this year. The next announcement is going to be June 10th. And then after that, there will be another announcement in July 15th. And then we have three more announcements this year in September, October, and December. So that was our interest rate discussion, and we will discuss that. But before that, this is again a graph I want to point out. It doesn't matter the market has already shrunk by 20, 25%, 30%, whatever we say, since 2022. Even despite our average price is around 1,067,000 at the end of 2025, we started at 40,000 from 1973, meaning in those 50 years, approximately, average price has gone up from 40,000 to million 67, which is almost like 27, 28 times the actual price in those many years, right? So if we say in the next, say 30, 35 years by 2060, we go up only at 3%, which is less than half the growth we had in the last 50 years, we would be at a 3 million mark for the average price. And if we go up by 5%, which is still less than 6.5%, which we have seen the growth in last 50 years, during which we have seen two major recessions. One was in 90s when we went down almost 30, 40% in pricing. And second one is in 2022 to 2026 now, where we are already down by 20, 25%. Despite that, our average growth is 6.5%. If we go up 5% only in next 35 years, our average price will be close to 6 million. So it doesn't matter what happens. By 2060, average price will be between 3 to 6 million. So I think it's wise to invest into real estate. So to get more information, please book your appointment with one of us. And let's now open the floor for our expert panel. Thank you, everybody. Now we'll open the floor. Anybody have any questions? Please feel free to ask to our expert panel. And you know what? Let me break the ice. Let me start asking our expert panel their opinion about the interest rates. Where do they see the interest rates are going in the next little while? So maybe we can start from Kishore. If you can chip in, what do you expect?
I see a slow, gradual increase, Sam. uh, it's not going to be drastic, like you said. It's going to be gradual. It's going to hover around high threes, low fours. And I think this is, like I mentioned before, this is the new equilibrium rate for a while, and still not really bad considering, when 22 and I mean 20, later half of 22 and 23 rates were much higher, and market was still somehow moving, right? Considering where we were then and where we are now, it's still a much better rate environment.
Fair enough. And do you see interest rate going up this year or not? Make a bold comment.
My, I think yes. I think we're all bracing for a slight increase towards the end of the year or early next year.
Okay, fair enough. And fixed versus variable.
It's the same thing. My clients are always the same. It's all about cash flows. Look, and I think people are more cautious now than they were ever before, right?
Mhm.
Before, I think now people take the actual modeling sensitivity analysis between fixed or variable more seriously when making this decision, based on what happened the last 5 years ago when people took variable.
Yep,
And my position always remains the same. We do a cash flow analysis or modeling analysis where rates go up a 0.5%, 1%. If your answer to both those outcomes are you'll be okay, no compromise in lifestyle, then yes, then you go variable because it's a calculated risk and you've mitigated that risk.
fair enough. Fair enough. Great. Thank you. Thank you for your feedback as always. And let's ask other mortgage brokers if Amit is here. Amit, if you can chip in, give your opinion.
So this one's a hard one for sure because we have someone down south that's mitigating what's going to happen. So if we're all optimistic and the war ends today, um, before the Bank of Canada makes any decision, they're going to see how quickly the gas prices drop. And unfortunately, we know how stubborn he is. So most likely it's not going to end. And I'm with Kishore that we'll probably have later in this year, probably about two increases just to help to mitigate so we don't have a repeat from 2022.
Okay. So you're expecting two increases later this year? Because we have, I think,
Yeah, and the biggest key factor, unfortunately, onto that is gas prices. If we look at a year over year, a little more in depth, gas prices itself from last year, June to this year is going to be sitting at about a 5% increase,
yeah,
right? Now factor that into the measurement of everything else, groceries, etc. That's going to measure. So therefore, it may actually push the inflation higher due to the one factor, which is the war.
fair enough. Yeah, that is something which no one has control over and no one can see what's the future, right? So
Yeah,
unfortunately, there's so much uncertainty about that. Yeah, maybe that's the reason a lot of banks are not in sync. Everybody have their own opinion about the war and about the prices and its impact. I think the impact of oil pricing is different for different in different people's mind, right? So that's another reason.
yeah.
Anyhow, your take on fixed versus variable.
I'm with Kishore. We do a cash flow analysis. But then there's two options. There's multiple lenders who have a static variable option. So you
Mhm,
could take advantage of the variable rate, which is lower today.
mhm,
Even if there is a 0.5% increase, you're pretty much at a break even of the fixed. So when we are running the cash flow analysis, we're already looking at the fixed rate of
mhm.
what it would have been today, and we're running the basis off that. So 9 of 10 people are still going variable because they've already done the calculation or their financial planning based off what the increase would have been as of today. The other thing is some people they're doing a split of both, right? So they're reducing the risk, they're taking the fixed option, and then they're also doing the variable rate option.
Fair enough. Yeah, good. Thank you. Prerna, I see you in the panel here. Can you please jump in and give your opinion?
Uh, sure, Sam. Thank you. Thank you for having me over here. Again, the market is so confusing. Banks are so confused as well. So they are not in sync. So ultimately, why are we answering this question? We are answering this question because clients are coming up and they're asking, should I take variable or should I take fixed? And again, it for me, it comes down to the risk appetite. And as Kishore and Amit said, we do cash flow analysis, we do the stress test even now, and we see if they're able to afford payments once, even if the rate increases by 50 basis point towards the end of the year or next year, will they be okay? Then sure, go for variable rate. Otherwise, just to have peace of mind, for some clients, I suggest go for fixed rate. So market is confusing. I know there are multiple rate announcements this year still left, and there could be some slight change. It can go upwards, but do your risk analysis yourself or sit with one of our mortgage brokers, and we can help you make decision.
Perfect. Thank you. Good. And is Rajat there on the call as well? I think I saw him. Rajat, are you here? Yeah, I see his name is here.
He's here.
Yep.
Hi, good
Yeah.
morning.
Yes, Rajat.
Hi. Yeah, I think that the interest rate for this year is gonna be steady and it's not gonna go up and down. But yes, next year 2027 they are saying that it's gonna be one increase. I don't know about two increases, but one increase for sure is gonna happen. But let's see. It's market is not. I cannot predict the market right now, but it's gonna be one increase next year, not this year.
Okay. Fair enough. And your take on fixed versus variable, Rajat?
I what I think right now, my clients they are looking for a variable rates, so they can they are not they don't want to go in a fix right now. So variable, I'll take variable.
You go variable.
Yeah.
Good call. Thank you. Bhavin, I see you there in the corner, my friend. Jump in.
Hey Sam, how are you?
Good, good, Bhavin.
Sam, I think I'll go right variable versus fixed. I've always been a variable I like variable, and long-term variable is always good. So in opposed to clients deciding variable versus fixed, now there are different kinds of clients. If the client is someone who can sleep, who cannot sleep at night when the rates could go up, then fixed makes sense for them, because again, there's speculation, and if they cannot digest the speculation, it's better to go fixed. But if there is a client who says, yeah, you know what, I'm speculative, I can take risk, then what they can actually do is take a variable rate. Currently, the difference between a variable and a 3 or a 4-year fixed rate is 50 basis points. And if you see, all the banks are saying that there's a chance that the rates could go 50 to 75 basis points higher. They can hedge it right now, meaning what it means is go and make that extra payment right now from day one, take a variable rate and pay based on a 4% rate. You're already hedging, and speculation is to your advantage. If the rates don't go up, you're already making a dump in your mortgage. So either way they win. So again, variable with hedging.
Very well said. So Bhavin came with a different solution today, saying go variable, but consider you're at a fixed rate and start making payments based on fixed rate. So you're hedging against the increase, and you're already having at least half a percentage advantage till the time it actually increases, if it does increase. And if it does not increase, you're a winner. Even if it increases, as you're right, Bhavin, to some extent, because most banks are predicting an increase of 50 points next year or this year, right? Except only it's RBC, which is saying 1% full points, but most of them are saying 50 basic points either later this year or next year. So it means even if it goes 150 points up, you're still at par. If you take variable, you'll be still at par with the fixed rate which you will be getting today. And you'll be paying that rate for at least till the time it actually increases, right? So yeah, it's a good strategy, I think. But again, everybody's situation is different. Everybody's risk appetite is completely different, as we always say, and mortgage brokers are recommending. So yeah, so based on that, you need to sit down with these very qualified mortgage brokers. They are doing it for last many years, and they have helped many clients, and they have seen different scenarios. So they can actually guide you through and help you to choose what is best in your situation. Great, thank you. Let's look into if there's any other questions from the audience. Let's check if there's anything. Neelam or Pallav, if you can read, if there's any questions which I did not read. Let me see. Because I'm asking all the questions, but I see sometimes that people, I don't see any chat here or chat questions here. Okay. Anyhow, so what I would also like to ask to also the expert panel, are you getting more pre-approvals done now than in the past? Because that's also an indicator where the market is heading to, right? Because all these people who are potential buyers down the line, right, they start going to the mortgage brokers and getting pre-approval. So you are also getting, you get some information upfront before actually the market changes. So that can help us to also make some decisions. So Bhavin, I'll start with you again.
Sam, sorry, if I summarize your question, you're saying our clients doing pre-approvals?
Yeah, are you getting more pre-approvals than normal market, or are you seeing more pre-approvals now than you were seeing in, say, 2 months back, 3 months back, 4 months back, or 6 months back?
So Sam, yes, if a client is a first-time home buyer, are definitely looking into getting those pre-approvals just because they're new in the market. Yes, we are getting those pre-approvals for mostly the first-time home buyers. Pre-approvals are not good for investor clients or someone who's buying a second-time home or third time, because pre-approvals are mostly a system-generated approval where a lot of the times the lenders are not looking at income documents. It satisfies the client's need or curiosity that they have a letter, but no one's looking at the document. So again, usually based on experience, we can say that we can get it approved or not. But yes, for first-time home buyers, 5-10% down payment pre-approvals are happening. Yes, mostly first-time home buyers.
Perfect. So yeah, that's what we want to know, if there's more activity, because you can
Yes,
see activity before actually
end
happens.
end users are looking for pre-approvals. Yes.
More end users. Great. Thank you.
Yeah.
Same question. Anybody else want to jump in? Either Amit or Prerna or Kishore. Are you guys seeing more pre-approvals in the market?
I think
I'll-
there's two different things we got to look at. Sorry, Kushar.
No, you go ahead.
Sure. Okay. So I think there's two things that we got to look at, and I know I'm sure Prerna can actually relate to this more with me. Kushar probably not as much, just because of the access that we have versus multiple versus the one. There's a pre-qualification and there's a pre-approval. Personally, I hate pre-approvals. The reason why is the pre-approval is generated based off a specific property. Pre-approval is more based for rate holds. So for example, Sam, you show me your property tax is 5,000, heating is standard, condo fee is 0. I give you a pre-approval. The assumption is the client believes that that pre-approval is good for everything. So now they'll go to another property. Now there's a condo fee. Now the property tax is higher. They can actually go from qualified to not qualified, right? So personally, don't like pre-approvals. We prefer pre-qualification. So what that means is we're actually taking your income, the property you're looking at, and we're actually running an analysis based off the property you're looking to purchase. So you may actually get approved with the lender today at X, but the next property that you actually are making the offer on, you may no longer qualify, and now we have to take you to another lender. Because depending on, as Bhavin said, owner occupied or rental, we can do both. Each lender has different policies that you may be able to fit in for one and not fit in for another.
Fair enough. Maybe my question, I just want to rephrase it to make it more simple. My question was to understand, are more people now asking or coming to get pre-approval, especially the first-time buyers, which give us some indication that yes, more buyers are coming into the market.
There's more people coming in at getting pre-qualified, I would say.
Okay, perfect.
They're trying to find out what their pre-qualification would be.
Yep, that's exactly what I wanted to understand. Thank you. Kishore, what do you say?
I'm sensing the same. Right now, there's a cohort of, I would say, smart first-time home buyers who want to take advantage of locking the rate and these HST opportunities that are presenting itself, and opportunities in the resale market that said, hey, let me lock in the rate before it slides up, and let me get in a great price. And yes, I would say there's definitely a big uptick in pre-approvals that are issued, and especially to those in the first-time home buyer segment.
Fair enough. Good. So there is some uptick in pre-approvals, in other words, or pre-qualifications, right? So which ultimately meaning more people are now thinking of buying homes.
Correct.
Right. So which ultimately gives us some indication that hey, if we are seeing more activity, and you are also seeing more pre-approval activity, it means our volume will also increase further down the line.
Correct. And it's one of the other big common reasons I'm hearing right now is a return to work. As more companies are returning to work, more people are motivated to buy.
Yep, that's another very good indication. Yep, absolutely. Thank you. Great. And I would ask this question maybe from any accountant. I think Deepak is here or Mustafa is here. Some people are now selling their condos or investment properties and losing some money there, right? And they were asking, and a couple of investors asked me, hey, if they can write this off against their capital gains from other sources, maybe stocks or some other asset class. And again, I'm not an accountant. I told them to talk to your accountant, but maybe it's a good platform to ask that question. So if someone has lost money in real estate, investors, especially who are selling their condos, are they able to offset that losses against some other asset class or some other income from other sources?
Sure. Sam, I can jump on this for
Yep.
sure.
Yes, Deepak.
So obviously, I always say is that talk to the content is the best opinion because this is very specific with the individual, their portfolio, their future goals, and also the history as well. So just to give you an answer, which is more likely a high level, the capital losses can be offset against capital income only, not against any other income. So as a definition, the capital gain and losses is only when you're selling your assets. That assets could be a real estate asset or it could be an investment as well. Okay. And the good thing here, I have done this with another client as well. Uh, Usually when you have investment capital losses, you have the opportunity to go back as well. So if you have capital gains in the previous years, I don't recall the number, I think it's 7 years or 3 years, one or the other. So you can also carry back if you have sold some investment in the previous years, you have capital gain. You can also carry the capital losses back. You have to complete certain schedules. That's one option. And the second option is you generate a loss and wait for your future capital gain, right? And you can carry it forward anytime in future you sell another investment that generate a capital gain, you will save taxes because that capital losses will stay on your record under your personal taxes if that investment was sitting or sold at a personal level.
Fair enough.
Yeah. The other thing that also tell here as well, because I have one client who just sold his personal house, which was a principal resident, and he had a big loss on that. And he was saying, okay, well, can he offset against another condo he that has appreciation? I said, well, the good thing is that you don't pay capital gain on your house, but neither you can use any capital losses on your house as well. So if it's a personal, if you say that, okay, well, I have a loss and I can sell my house and I have a capital gain on that, that's already like no benefit there. And even if you have loss at your personal home, there's no benefit as well. So yes, to answer your question, yes, you can use it, but only against your capital gains in future.
Fair enough. Thank you. That was very informative. Great. And you know what? I know the time is now 5 minutes past 11. So I appreciate everybody's time and respecting everybody's time. Everybody have other commitments. So we'll call it a day for the session today. But if anybody have any other questions, they want answers from our expert panel, please feel free to send it to us and we would get your answers and send back your responses. So I appreciate everybody's time today. Thank you for tuning in. Thank you for sparing your Saturday morning with us and wishing you a happy spring.
And wishing you happy birthday, Sam.
Yes.
Thank you. Thank you, everybody.
Thank you.
All right.
Happy birthday, Sam.
Bye.
Thank you, everyone.
Thank you. Bye for now.